Very good afternoon, good morning. Welcome to the FX Week Ahead Live Market Analysis with myself, Giles Coughlin. Very warm welcome to you. Looking forward to taking us through the session, explaining what's going on right now, as well as looking at some very key opportunities that we have this week. Now, just as we're getting started, don't forget, as we look at different entries, exits, the whole idea of this webinar is that we are looking at trading from an educational perspective. It's not that I'm offering a signal trading service, it's that we're looking at various policy expectations, economic events, seasonal patterns, and I'm showing you how I, with a professional trading background, go about making trading decisions. So it's from an educational perspective rather than a signal trading service. Those of you who are regular, you understand exactly how this works. So a very warm welcome to you. Good to see you, Warren, Stefan, Richard, great, Max, Mark, Hits, Gary, super. Really looking forward to this session, and we'll be just taking us through and getting us up to speed. These are the things we'll be looking at in terms of individual events. The key kind of economic events that we have coming up is the Bank of Canada and the Federal Reserve meeting on Wednesday. We'll look at that, and we will look at that nearer the time as well, particularly if there could be a decent trade setting up for the dollar CAD or maybe the Aussie CAD. We'll go into that in some detail on Wednesday as well. But for now, this is some of the key data points that we'll be just running through. Given the fact that so much has shifted today, I want to just really underline where we are with markets so that we are really clear and it really makes things, obvious to us. Just share the right screen. There we go. Great. Right. Now, what are we seeing today? Well, we're seeing a wall of worry on two major events. First of all, there is the issue of Ukraine and Russia. There has been some tensions ongoing for years now about the relationship with Ukraine and Russia, and particularly the annexation of certain parts of Ukraine under Russian leadership. Now that has really irked NATO and the US, as well as Ukrainians themselves, understandably. So there's this tense standoff between Russia on the one hand, who have amassed a huge melee of troops around the Ukrainian border, and the US and the EU, who are starting to warn about sanctions. Now, politically, there is some difficulties here. Now, the difficulties is, if you look at the European Union and their trade with Russia, it's around 104 billion in terms of the exports to Russia from the European Union. That's the number 5 trading partner, so a significant European trading partner. But for the US, it's only 13.2 billion, which puts them at like 30th in the list of top trade partners with the US. So that means that the European Union stands to lose more by putting strict regulations on Russia should there be an incursion in Ukrainian space. Now that means that Europe will be a lot less likely to want to hurt itself, because you can see the imports from Russia, 177 billion, exports 104 billion. The US is much smaller footprint, understanding the geographical distance. Much of Europe is connected to Russia via a land mass, which makes trade much easier. So as a consequence, there's another factor to consider, which is energy. And Russia provides a huge amount of natural gas to Europe. So if there is some tensions, look out for natural gas. We could see a sharp spike higher in natural gas prices. I wouldn't be surprised to see that happening should there be an invasion of Russia into Ukraine. Also, that will likely accelerate the current risk-off tone. So be aware of that dynamic going on. That's a major risk. That's why, as we just take a look around markets, you can see the dollar's finding bids today, the Antipodeans, the Aussie, New Zealand dollar weakness. Pounds also low. UK PM Johnson is struggling because he has a big leadership battle on his hands. Now, there's big news here over in the UK, and essentially what's happened is PM Johnson is there's a report going on that's being issued by Sue Gray. It's called the Sue Gray report, and it's about whether PM Johnson was actually having parties at number 10 Downing Street, while the rest of the UK was in very strict lockdown. Politically, it's a very big home goal for PM Johnson, and many commentators think this could potentially be the end of PM Johnson's premiership. It's a bit of a coin toss whether he holds on or not. This Sue Gray report is due to be out, I think, this week, so that report could be the decider whether PM Johnson is, staying on or not. If he doesn't stay on, expect an initial downside in the pound. Now, the falls in the pound today is, yes, that political pressure, but it's mainly the dollar strength. Dollar's strengthening on the risk-off tones. But if PM Johnson does resign, or there's a leadership contest, expect immediate downside in the pound, but then it'll be instantly focused on who's replacing PM Johnson. Now, at the moment, it's expected to be like Rishi Sunak or Liz Truss, the Foreign Secretary. Rishi Sunak's the Chancellor. So that kind of is a more pivot towards fiscal conservatism. That should be medium-term bullish for the pound, bullish for the FTSE. So keep an eye out. If we see strong indications that PM Johnson is either going to resign or the leadership contest, pound sell off, but then watch for a bounce. At the moment, though, it's this risk-off trading which is likely to accelerate things. So have to be very careful about the risk tone. At the moment, we're tilting off. Copper moving lower, oil prices moving lower. The thing with oil, remember, at the moment, is there's really mixed pictures going on. Now, let me explain what's going on. So first of all, this is why many macro traders are skeptical about oil's gains. Now, have a look here. Let me show this chart. Now, this chart is inflation expectations. This is a 5 and a 10-year inflation, break-even inflation rates. Now, typically, this will give a good indication of where oil's going. Now, the reason inflation is moving lower is because the Fed's expected to hike interest rates as much as 4 times this year, which is resulting in inflation expectations falling. Because the central bank raises interest rates, inflation will fall. In the US, inflation is very politicized. As I've said a number of times, I was speaking to a US media house I think about 6 weeks ago, just before Christmas, and I ended up speaking about inflation for 40 minutes. That told me how politicized inflation is. I was there to talk about currency. I had lots of different things to say, but no, they just wanted to talk about inflation for 40 minutes. At first, I was irritated, but then I thought afterwards, oh no, they're not being rude to me. It's just the fact that inflation is such a big issue over there in the US. And obviously being here in the UK, I hadn't sort of really picked up on that. So the fact that inflation expectations is moving lower, right, typically that would drag oil prices lower. You see here how oil tracks the inflation, oil's the purple line. So you see that jaws opening up between oil prices and inflation rates. Typically they would follow each other, right? So from a macro perspective, many folks are skeptical about further upside in oil prices. But the difficulty for traders, and particularly oil traders, is that there are some good reasons for oil prices to keep moving higher as well. And we have things like very low inventory levels. EIA revised up demand for oil. We've had Turkish pipeline problems. We've had UAE drone attacks. We have potential of Russia and Ukraine falling out, and then a key petro country like Russia suddenly not being able to bring their oil to markets. All of that supporting near-term oil. So there is this big mixture. At the moment, oil is just slightly positive on the day, but very mixed drivers, mixed risk tone. Typically in a risk-off trading day, you see oil fall. The individual drivers supporting it, that 85 region will be crucial. Copper lower, but copper sort of supported by the action from China. We'll mention that later. And copper tends to have a very strong February from a seasonal perspective. Do check out my blog for more details on that. Looking at Bitcoin, this is a great asset to really look at, like risk for tech stocks. Got very similar drivers to the NASDAQ at the moment. You see, this is a NASDAQ overlaid on Bitcoin. And if people are worried, investors are concerned about tech stocks, you often see it in Bitcoin. And you can see here, look, you know, we're moving down towards that 30,000 region. Now, if 30,000 hold, Germany, we're looking for more. On a first test, you'd expect 30,000 to hold, okay? So that's a decent area to potentially look for a little bounce. You can have a little technical bounce there. Buying limit 30,000, stops just 27, 26,000. You definitely expect a bounce up to 31, 30. Maybe definitely up to 31,000. So there is a short-term bounce you'd expect to see there in Bitcoin, similarly to what we saw when we saw this 40,000 region. So 40,000 tested, then we saw a bounce back up to 41, even up to 42, 43. So similarly, entering at 30,000, you'd expect to see a little bounce up to 31, 32. It could be worth it for a technical bounce. You've got to measure the risk. The problem is you really need your stop sort of sub 27,000, so it may not be worth the risk. But I do point that out. Don't forget the phenomenon of turnaround Tuesday, which is now you see often when you see markets down on Thursday, Friday, and Monday, it obviously depends how it closes, you often see a turnaround Tuesday. Now, the only caveat to that this time is that Russian-Ukraine issue. If that bubbles over, then there won't be a turnaround Tuesday because assets will be selling off on big worries. Now, volatility, the VIX is pushing higher. Now, if you haven't seen this before, what you'll notice is that when you overlay the S&P 500, you'll see that rising VIX, falling stocks. Okay, that's the way that the correlation is, because all the VIX is really showing you is the ratio of call to puts on the S&P 500. So what that means is when the VIX is rising, it means more S&P 500 traders are buying put options, which is a bias for the market to sell off. So rising puts, falling stocks, rising the VIX, falling stocks, rising the VIX, falling stocks. We've got the VIX rising, okay? And as long as the VIX is rising, then that will be a good indication for stocks to keep falling. So don't look at any potential turnaround in stocks until we start to see the VIX moving lower. At the moment, VIX is trending higher. Medium term, any retracement down to 7150 looks decent for the FTSE 100. Again, watch out for that if there is a PM Johnson leadership challenge. That's key support. DAX breaking through that support level, and Euro stocks, significant levels. S&P 500, next major level, you expect a bit of support down that 4,243 region. Not sensible to try to catch a falling knife. Normally, I'd say look out for a turnaround Tuesday, but with those Russian-Ukraine tensions ongoing, just better to leave that to the side for now. And again, the reason stocks are selling off so much is because expectations that the Fed are hiking just as growth and inflation is slowing. So this is investors very worried that there's a policy mistake. And if you just take a look at like tech stocks, the Nasdaq, I mean, look how incredibly steep that rise has been. Remember, this has been during COVID. So tech stocks have benefited a lot from this sort of acceleration of digitalization. We are now living in the digital age. We have the industrial revolution. Essentially, we are living through the digital revolution. Historians will look back at this time and see it's a key time for digitalization. Tech stocks have really gained during lockdown as that digital pivot has just been accelerated. But very overcooked. Selling through that trend line, be very careful of buying this tip. You want to wait to see what happens. If you want to see a sense of like a stock market correcting, look how China's 50 index corrected last year. See it moved from 2,500 all the way down to sort of 14,500. So, significant falls. Now, China, this looks really good value for the medium term. Now, People's Bank of China. Now, if you notice, you look at the Chinese stocks, think, oh, okay, well, hang on, look. All these global stocks are selling off, VIX is rising, but China's 50 is pretty stable. Why? Well, that's because, unlike the rest of the world, China's stocks saw a significant pullback last year. It was retail. Remember the Evergrande crisis? There was questions about whether Chinese companies are actually independent or not. The pivot towards socialism from the main Communist Party in China, all of this was just weighing on Chinese stocks, and we had a slowdown in growth, right? Well, now the People's Bank of China has been cutting interest rates. So we had another interest rate cut last night. They cut to 2.35% to 2.25%. And there's also hopes of fiscal stimulus from the government. So all of this means that, you can see the sell-off has been, it's selling off today, but it's really contained. So medium term, the A50 looks really attractive from a medium term perspective. I'll expect to find buyers at market, and you can just put your stops nice and tight, just below that 14,900, 14,500 region, looking for a play back up towards those 17, 18, 1900 highs. That does look good. Just check the any broker fees you have with that. But from a medium term perspective, that is at support. And with this risk off trading, the fact that it can't really sell off hard at the moment does give you a good indication that any kind of recovery and the A50 will really benefit from that. Okay, folks, I think we got a sense of where we're at. Yeah, just intraday, just what showing you, we're seeing that sort of key risk-off markets. Swiss franc, US dollar strength, yen. All of these currencies are strong on the risk-off flows. Aussie is weak on as a high beta currency. New Zealand dollar holding up a little bit more than you expect. CAD being supported by oil, but that risk-off the trio, Swiss franc, US dollar, Japanese yen, is really quite telling. Don't forget we have some key events coming up this year. Okay, it's a long introduction, but it's needed it today. Definitely has. If you just take a look at the key events to looking forward to, this is what I'd say. So first of all, those European PMIs we had, right? Okay, a bit of good news under the hood here. Services, yes, not as great as you'd hope, but still above 50. So that gives a little bit of hope. And sorry for the European services, sorry. The services PMI not as great as you'd hope, 51.2, but still above 50. And also doesn't look as bad as last winter for the Eurozone. So that's a win, even though it's a little loss. It's not as bad as it could have been. And important manufacturing showing some good gains, 59 versus 57.6 forecast, excellent. Also, some manufacturers were noticing that some supply chain issues will begin to ease, particularly with logistics, and that will mean less pressure on prices, so that should support inflation concerns. So in theory, the ECB have less reason to hike interest rates and can keep to their mandate, which they've been trying to keep to very well, which is just that inflation is transitory. So, it's good news for the Eurozone, nothing to worry the ECB there that I can see, but there are some things to encourage them. Look, Germany, the largest player in Eurozone, manufacturing back up 60.5, excellent news. That is supportive for the Eurozone and also supportive of the ECB's mandate. They don't need to hike interest rates to control inflation because with producer prices, some of that input being reduced, that will be good news. So all in all good. PMIs data out of the UK playing second fiddle to the risk-off tone, dollar strength, and PM Johnson's struggling with his leadership contest. CPI being important for the Aussie later. Now, ideally, remember the last RBA meeting, if you just take a look here, look at the central bank watch section here. Looking at this, there were three issues the Reserve Bank, this is my blog, make sure you check my blog out, you can have a read through this at any time, okay? Now, there's three things the RBA are looking at. I'll run through. One, the function of the Australian bond market, right? Aussie 10 years have been soaring higher, right? Tick. Action of the central banks, right? Tick. Feds is really hawkish. Most central banks are expected to pivot hawkish. Tick. Most importantly, progress towards full employment. Okay, since the last RBA meeting, we've had two decent prints, 380,000 plus, from the report just after this. Then we had like 60 or 90,000 plus, 40,000 of those full time. That was last week. Tick. Inflation, right? So that's where we're at now. Now, if inflation is high, if it comes in above market expectations, then we will be expecting the RBA to take a bullish twist. That's supportive for the Aussie, right? The pair to look at is the Aussie Cad, particularly with both those markets being impacted by risk. Aussie Cad longs would potentially make sense on a good print there. If the risk tone recedes, then you could look at Aussie US dollar longs, maybe even US, yeah. Then we got Wednesday. This is the best day, right? We've got two big events. Now, Bank of Canada and the FOMC. Now that there's different views on this. So the Bank of Canada, they're expected to hike interest rates 6 times, just under 6 times this year. Fed 4 times. Now, Canadian inflation is a lot less under pressure. It's not as high as it is for the Fed. Now, what we want to look for here is our divergence emerging between the Fed and the Bank of Canada. Now, the Fed, I think they are politically motivated to deal with inflation. There is a risk that they turn more hawkish. The Bank of Canada don't have the same pressures about inflation as the Federal Reserve do. So I could see the Bank of Canada being a little bit more conservative than the market's expecting. Now, the only caveat to this is oil prices have been very high. If we start seeing oil prices selling off, that will just give the Bank of Canada extra reasons to be cautious. Are they really going to hike rates 6 times this year? That seems unlikely. So if we get any kind of pushback from the Bank of Canada, a currency pair I really like, if we get a hawkish Fed, will be a US dollar CAD long. And just taking a look, there. So looking at the, yeah, a bit of sad. My wife got COVID, annoyingly. Just found out today. That's why I'm checking out the COVID restrictions here in the UK. Now, look here. She's okay. She's got like flu-like cold symptoms, but so I'll be looking after her later anyway. Right, US dollar CAD. So you look at these pairs. This is a key support. So if we see a bullish twist from the Fed, they're more hawkish than the market's expecting. And we see the Bank of Canada more dovish, then look for US dollar CAD upside. Any retracements at the moment, back down to that 1.2500, ahead of Wednesday, I think it's suitable for buying, okay? So if we see a sharp dip lower, down to that 1.2500, I would expect buyers, stops just underneath 1.2450, and looking for a potential bounce up high. Now that's quite speculative, but I think that would be a reasonable anticipation. Now, for that US dollar CAD long to play out, you need 2 things. You need a more hawkish Fed, and you need a less bullish Bank of Canada. So do watch out for that on Wednesday. It is the best trading opportunity of the week for sure. And the alternative to that is the Aussie Cad. So if the inflation data out is strong for Australia tonight, and then we get a more dovish Bank of Canada, then also notice Aussie Cad longs make sense. You can have just stops underneath that 0.8944 region, or just underneath 0.8950, looking for a play higher up to 0.9050, 0.9150 and beyond. So watch out for that come Wednesday. Aussie Swiss franc, you can see that's medium term heading into a nice sort of potential support area. We look for potentially going long here. The issue, of course, is the risk off tone is forcing near term Aussie Swiss franc is pressure to the downside because of the risk off tones, bids into the Swiss franc, sellers of the high beta Australian dollar. But if that risk tone switches, look for Aussie Swiss franc upside, Aussie yen upside, New Zealand dollar Swiss franc upside, New Zealand dollar yen upside. Euro New Zealand dollar also looks good. You can see here from a medium term bond yield spread pushing lower between the German 10-year and New Zealand 10-year bond spread, even as the price moves higher. We'd expect this to pivot lower, okay? So this move higher doesn't look like it can be maintained with the bond yield spread moving lower. So, you know, selling at market is not the end of the world. Have your stops just the other side of 1.700, looking for a move lower, back down to 1.6700, and then back to 1.6600, just down below. Just have a look where the, ooh, where's my, oh, I just got rid of my screen. One moment, we'll just look at this again. So that's the best trading event for the week, is coming from the FOMC and the Bank of Canada. Advanced GDP on Thursday, if we see a big miss there, then expect that to potentially result in more equity selling, because markets might be concerned that that the Fed's hiking as growth is slowing. But also look out for the other reaction, which is if GDP slows, then maybe the Fed will be forced to pause. So that can go either way. So you have to watch out for that. It's a tricky one. But at the moment, with the risk tone as it is, get a miss there and expect more equity selling and US dollar upside and safe haven flows. Also got inflation, core PCE data coming in on Friday, but the main event of the week is Wednesday and the Bank of Canada and the Federal Reserve. Expect this to reset the tone the next sort of 1 to 3 months. So particularly with US stocks, this is a very, very significant and important meeting, and we've got the risk off trading for now. Okay, folks, that's the key major events. We'll have a quick look at gold. It's always one we want to look at. The best way that I've found to understand gold at the moment is looking at this chart here, right? Now, if you notice, if I just get rid of gold here, you see that real yields is in the blue. I'm using TIPS as a proxy for real yields. Red is the dollar index. Notice when these two charts are moving together, that's when you get the best opportunities. So when you get real yields falling and the dollar falling, or real yields falling and the dollar rising, it's the best opportunity. At the moment, it's got real yields rising, but the dollar falling. Now, if we start to see post-Fed, if we see real yields falling and dollar falling, right, or vice versa, look for a good reaction in gold. Do you see gold's overlaid here? Falling real yields, falling dollar, rising gold. Falling real yields, falling dollar, rising gold. Rising real yields, rising dollar, falling gold, right? You see? See that? At the moment, we've got idiosyncratic drivers. So yeah, you've got rising real yields, rising dollar, falling gold. Look, we've got rising real yields, but falling dollar. Gold's kind of a little bit tilted to the upside because the probably the move in the dollar is slightly more tilted to the downside. We have seen a recovery in the dollar, and some of those US dollar long positions have been unwound, but gold doesn't have a clear direction, not in my mind. So if the FOMC, we start to see, and the way you can tell real yields are moving lower, if you just suddenly see 2 10 years tank lower, okay? As long as inflation expectations remain as they are, then real yields will fall and the dollar will fall. Okay, so that's the thing to look at. But at the moment, just neutral on gold. There's a slight bias to the upside, but nothing that's really worth tradable there right now. Okay, folks. So whistle stop tour. Don't forget, I will be back here on Wednesday, and on Wednesday I will go through exactly how to trade the FOMC and the Bank of Canada. So make sure you don't miss that. Come back on Wednesday. We will look at that together, and we'll be totally prepared and totally up to speed on that. So every Wednesday, 12:30 to 1:30. Don't miss that, and we'll look at specific areas on the Aussie Cad and the US dollar Cad pair for sure. Okay, folks, take care. I hope everyone has a really good week. What link do we use on Wednesday, please? Just check with support, Max. I think it's for HYCM clients. So just check with support, ask them to send you a link. Max, it should be fine. Yeah. Any problems, Max, just send me an email. But only send me an email if you get a problem, and I can chase it up for you. I'll send you my email. Right, okay, there it is there. So if you get any problems, Max, just ping me a message or contact me on Twitter. For those of you who don't know my Twitter feed, I am here, and my Twitter handle is @GilesCochranCCA. So you can just send me a message there. All right, folks, take care now. Have a really good session. Thank you, one and all. Goodbye. Yeah, thanks, Stefan. Goodbye, mate.